What's going on, guys? It's Mike back with another video, and in this video I'm going to show you guys how you can use big lot sizes and still have a low amount of risk. I know with trading it's always about low risk, big reward. Okay, so I'm going to show you guys exactly how you can do that in this video. So right here we are looking at the USD versus the Japanese yen. I wanted to do this pair because I wanted to show you guys a very simplistic scenario. Okay, so a lot of people are always talking about, what's the best time frame to trade on overall. So it's not about having the one best time frame. It's never about that, because all the time frames are one. You have to get your directional bias on the higher time frame, and then you can go down to the lower time frames and get the best entry. But in order to get the lowest risk, you have to go all the way down to the lowest time frame. I'm not just talking about 15 minutes. I'm talking about the 5 and the 1 minute in this example. Okay, so right here, just based on the higher time frame, you can see that price was in an uptrend. You can see it made a higher high, higher low, higher high, higher low, and it started making lower lows right here, retesting the previous area right here, and then she ended up breaking and then retesting. So this area right here is actually the area of interest. This is the area of interest that we want to look at, and this wick right here in general is very important. If we go to the weekly chart, you can see that it was bearish. This candle was bearish in the previous week, and it ended up rejecting this area heavily. But this was something where you wouldn't. I mean, you as a good trader, and you've been trading for a while, you kind of would have seen what was going on. But for a newer trader and stuff, a lot of times it's best to really go down to those lower time frames. So we're gonna go straight to the 4-hour so we can get more information. Now we can see that now on the 4-hour chart we do have another wick right here. You can see we have that other wick. So what I'm gonna do for you guys here is I'm gonna go down and we're going to highlight this again with the eclipse, and then let's make it a different color. So I'm gonna go ahead and make it white. Okay, we'll make that area white, and then we're gonna go down to the H1. Now we're on the H1. Now we see even more information going down here, and I'm gonna show you guys the difference in this. So a lot of people, they'll come in these markets and they'll be like, okay, well, if price does come down to this area, or whether it's retesting a previous resistance as a new support, or you're getting in on a retest after support's been broken and then it's retesting that area as a new resistance. So if you want to get the best risk, you want to try and get in as early as possible. So when price gets around these areas of liquidity, there's going to be signs of rejection. That's always going to happen. There's going to be signs of rejection if price doesn't want to break an area of supply or an area of demand. And this is something that you have to take advantage of, okay? Because before it actually starts rejecting the area and breaking structure and all of that, it's going to go from the smallest time frame first all the way to the higher time frames. Well, Mike, what do you mean by that? Okay, well, if you go down to the 30-minute and you see how the candles look differently, this was actually happening first before the 1-hour candle looked like this on how these were. And then for the 15-minute, this was actually happening first. You can see there was a nice rejection candle right here, and then a bullish candle right here, buyers. And this actually after that closed like that. Now we're seeing a little bullish momentum coming back into the market, but then it also made a higher low on the 15-minute chart. We didn't see a higher low on the hour chart. I'm sorry, guys. We didn't see a higher low on the hour chart based on what we saw in the 30 and 15-minute. And this is why. So these wicks are basically the higher highs and higher lows that you're seeing on the 15 and the 30-minute chart. And you can see it here clear as day. So this is very important, guys. So this goes into my fact of, things are going to happen first on the lower time frames before they build up to the bigger time frames. So if you scroll down even further, and I'm going to show you guys how you're going to get your good risk. Okay, so if you scroll down even further, now we're on the 15-minute chart. Again, you can see it, how fast it happened. We're going to go down to the 5-minute chart. and you can see the 5-minute chart. The 5-minute chart had a nice little double bottom here, and then it had a break of structure right here, a retest on this whole area, and then, you know, obviously passing that moving average of ours a lot earlier. Now, this gives us an even better entry off of this rejection, but if we go to the 1 minute, I'm not going to do 3 minute. If we go to the 1 minute, this is where you want to be. So if I zoom in on this area, okay, this would have happened a lot faster than the 4 hour, the 1 hour, 30 minute, and 15 minutes. So your entry could have been right here. Now, for some of you guys watching, you'll be like, well, Mike, isn't that kind of risky? If you want to make the most money and the most out of the trade, you want to be able to anticipate these moves. Yes, this little area wouldn't have been shown as a strong, bullish variation based on the 4 hour. If we go to it and I scroll down to it over here, you see the 4 hour, down here, it was actually just a wick. You can see that our entry, our little thing was down here. But because it's so small, this is a primary example too, is because we're on the 1 minute chart. So all of this whole wick based on the 4 hour chart was holding data. So as that 4 hour candle was coming down close to our daily area that used to be resistance, now organized as a new support, we are going in on the lower time frames and we're taking advantage of it, seeing how we can anticipate this move a lot earlier and get in before it even happens and starts to form on the higher time frame. So with that being said, this was very, very useful. You had an opportunity right here where you could have got in and then stop loss behind that level. Now, this is how I get my 5 to 10 pip stop losses, guys. I'm not bullshitting you, bro. This is how you can do it. Some of you guys are like, well, dang, I can't really make no money with a smaller account. If you want to make a good amount of money with smaller accounts and you want to use that dollar lot size lot or that point, that $2 lot, whatever the case may be, or even $3 lot, this is how you do it. 12 pips with a dollar lot, that's $12. This is something that you want to take an advantage, okay? And the targets would still be the same in my opinion, but some of you guys, like I always tell you guys in my videos, some of you guys may be cool with 20 pips. Okay, cool. That's a 1 to 6. That's not bad in this example. Some of you guys may have been good with 30 pips. Okay, cool. That's a 2 to 4, almost 2 to 5. That's another reason. And that's just off of that 4 hour wick. Now, if some of you guys are going for the bigger move, that bigger target, and I'm saying you're holding your trade a lot longer, that's cool too. Okay, we're going to go to the 4 hour chart. And I want to show you guys what kind of position you would be in if you actually had taken advantage of this. Okay, so this is actually where your stop loss would have been right there, and if we bring it over, you can see you would have been so well in position to where you could have taken price up all the way right here. That's 400 pips with a 12 pip stop loss, and I kid you not, man, try this out, bro. Try this out. Now, some of you guys may have bigger accounts or whatever, and you don't need to hold this long, but this is how you can really take advantage of it. Say you got, say you got two, you're twin trading it. You got $1 lot and you got another dollar lot. You know what I'm saying? You make your money. If with a small account, you make your money on the first dollar lot size, and then the second dollar lot size you just hold as a swing. But you're going to be in such a good position. Look how you were on the 4 hour, and look how you were position on the daily. Now, a lot of you may be a little bit scared if I go into replay mode. A lot of you may have been a little bit scared to actually take a move like this, but this is why you have to go down the lower time frame so you can see what's actually happening once price approaches the area that you feel as if and you're predicting that is going to reject. Okay, so this is something that you guys want to take into consideration. I hadn't seen a lot of people actually explain this on YouTube. Correct me if I'm wrong, but I did want to break it down for you guys as far as like finding that perfect entry time frame. This is something that's so important and it's overlooked. People don't really know the power in this. Like even this whole move in general, like if you wanted to go off of your daily bias or your daily fib, you have that your fib from the swing high to swing low. type deal. And then you have your targets for TP1 right here, TP2, and then TP3, and then TP4, which is dang near almost 1,300 pips. So this is something that you guys want to consider, man. Oops. But that is it for this video, guys. If you did enjoy it, drop that like button, comment for what you guys want to see next, or even comment if this actually helped you guys. I know some of you guys have showed me a lot of love in the comment section and liking these videos and subscribing and all that good stuff. So thank you so much. But like always, I will see you guys in the next video. Peace.